welcome to the deep dive. Every day the market intelligence we get tells a complex story, but today's briefing on Bitcoin is particularly fascinating. It really reads like a massive internal conflict.
It absolutely does. It feels like we're looking at two different markets at the same time.
Exactly. We're getting signals that argue for bullish strength and, at the same time, warnings of pretty imminent danger.
That's right. And when we look at the sources, it's not just volatility, it's this deep divergence. Analysts are calling it a late cycle high dispersion regime.
Okay, so what does that actually mean for you, the listener?
It means that the price movement you see on the screen and the underlying structural health of the network are telling two very, very different stories.
So let's define the mission for today. We had this stack of contradictory signals.
Right.
On one hand, bearish capitulation, cycle top warnings. On the other, you have strengthening whale demand and huge infrastructure upgrades. Our job is to synthesize this tug of war. How do you decide if this is a trap or, a real foundational opportunity?
Well, the core conflict really is between that short-term tactical risk things, like the daily outflows, the realized losses we're seeing, and the longer-term structural validation.
The deep pocket accumulation and legal certainty.
Exactly. So the synthesis today argues that this is not a moment for making emotional bets. It's really about sticking to rules-based allocation and risk management, especially with the market being so sensitive to key thresholds right now.
Okay, so let's jump right into that. Let's unpack the short-term price action. BTC is currently trapped in a very tight corrective range. It's oscillating roughly between $90,900 and $93,600.
And the key level that seems to be absorbing all the attention is that $93,000 resistance area.
That's what?
It's acting as this critical inflection point. If you look at the chart, the structure is sideways, maybe slightly down. We did establish a good higher low around $86,000, which is positive.
Right.
But, and this is the crucial part, we haven't managed to confirm a higher high above that resistance shelf from earlier in the month. So the market is, structurally neutral, but very twitchy.
And the briefing lays out two major outcomes from here. First, a sustained daily close above $93,000. That would likely trigger a renewed leg higher.
Yeah, that would be the confirmation that the uptrend is still intact.
But the risk scenario is a sustained breakdown. So if the market closes and holds below $85,000, that changes the picture dramatically.
It really does. In that scenario, analysts suggest we'd likely be targeting the $70,000 liquidity area, and that would be a pretty significant setback for sentiment.
Okay, so this is where we run straight into that massive paradox that's unfolding on chain. On one side, the data reports an astonishing figure, over $5.7 billion in realized losses in just a short period.
It's a huge number, and it's important to define what that means. A realized loss is when coins are moved or sold at a price lower than where they were acquired.
So people are selling at a loss.
Billions of dollars worth. This is the classic signal of short-term holders capitulating. It's often, retail investors or high-leverage traders being forced out of their positions, liquidations, risk limits being breached, that kind of thing.
Which on the surface sounds incredibly bearish. I mean, when you see billions of dollars in losses being crystallized, you assume the pain is just beginning.
You would think so. But here's the critical counterpoint. At the exact same time, the data confirms that large holders, the whales, are accumulating at a record pace right into this weakness.
They're the ones buying what the others are selling.
They are the exact counterparties. So what we're watching, really, is a live ownership transfer.
From weak hands to strong hands.
Precisely. It's a mechanical transfer of coins from sellers triggered by short-term fear to these strong hands whales with deep pockets and multi-year horizons. Historically, that's actually a structurally healthy thing for the market. It tends to compress future downside risk, even if it feels awful in the moment.
It's a compelling argument, but we have to address the elephant in the room. The briefing notes that CryptoQuant's on-chain tools are flashing a critical bearish signal that's historically associated with cycle tops.
Right.
If the whales are so busy accumulating, why should we trust a historical warning like that?
That is the right question to ask, and the answer is context. The market structure today is just vastly deeper and more layered than in previous cycles. We have regulated spot ETFs, regulated custodians, institutional balance sheets.
So it's not the same market where those old signals were born?
It's not. So a cycle top warning today doesn't necessarily mean sell everything. Its primary message is more like drastically reduce or eliminate your leverage and tighten your risk limits.
So it's a warning about volatility and risk, not necessarily direction.
Exactly. It signals that you should be prepared for a potential multi-month sideways to down grind. It's a major flag for liquidity risk, but it doesn't invalidate the strategic long-term case that the whales are obviously acting on. It just forces you to play defense.
Okay, let's shift to the institutional story, because the narrative we constantly hear is that every major firm now finally allows Bitcoin. It sounds like the floodgates are wide open.
Technically, yes, the door is open, but the briefing highlights this idea of an invisible compliance layer that is quietly blocking or at least slowing down that flood of capital.
It's not regulatory friction anymore, it's platform friction.
That's a perfect way to put it.
So give us some examples. What does this friction look like for, say, a wealth manager who wants to allocate?
Well, there are three main hurdles. First, you have suitability filters. If a client doesn't meet certain wealth or experience criteria, the Bitcoin products are just marked as complex and they're inaccessible.
So they can't even see the option.
Pretty much. Second, advisors often work from default menus, and the Bitcoin ETFs might be off menu unless they're specifically enabled. That just adds another step. And third, even if a client qualifies and wants a big allocation, you have these internal platform-level risk limits.
So the firm itself puts a cap on it.
Right. Sometimes it's just a few percentage points, regardless of what the client wants. It's like building a highway on-ramp, but putting 3 bureaucratic toll booths on it.
That explains a lot about why the institutional flow has been more of a trickle than a flood. But while that's happening, the actual underlying plumbing is getting much better.
Oh, absolutely. The foundations are strengthening every day. Take the launch of that new Wyoming blockchain-powered bank. It's offering an instant 247 B2B payment platform.
B2B, so business to business.
Correct. This is huge for crypto-native companies. It lets them move value and collateral instantly, which reduces latency and counterparty risk. It just makes institutional operations way more efficient.
And we're seeing traditional exchanges step up their game, too.
We are. Kraken just launched a new VIP service program for high-net-worth clients and funds. This is about aligning their services with traditional prime brokerage standards. Dedicated support, better risk tools, the kind of white-glove service big money expects.
These are those necessary, kind of boring steps toward full institutional maturity.
That's right. They're not flashy, but they're critical.
So given all these conflicting signals, the price volatility, the whales buying, the cycle top warning, how are the sophisticated players, the professional HO dealers, actually deploying capital? They aren't just blindly buying every dip.
No, not at all. The report makes it clear they use a highly structured framework to take emotion out of it. It starts with what they call a base DCA schedule.
And for anyone who doesn't know, DCA is dollar cost averaging.
Correct. So that's just a fixed periodic purchase, say, buying every Monday no matter what the price is. That's the backbone of the strategy. But crucially, they layer that with tactical overlays.
Okay, what's a tactical overlay?
These are extra structured buys that are triggered only at predefined drawdown thresholds. So for example, they might have an automated rule to execute a large buy only if the price drops, say, 20% or 30% from a recent peak.
So that prevents the emotional panic buying and ensures they have dry powder when everyone else is capitulating.
It systematizes buying volatility. It turns a choppy, difficult redistribution phase, like the one we're in now, into a source of long-term return. It's the discipline that prevents you from making those big pro-cyclical mistakes.
Shifting to macro flows for a second, we saw a really concrete signal of short-term caution recently. The spot Bitcoin ETFs had a $195 million net outflow. That was the largest in 2 weeks.
And that data point is the perfect illustration of this redistribution phase in action. You've got $195 million leaving the public, regulated ETFs that's likely profit takers, tactical traders reacting to the chop.
Right.
But at the same time, as we noted, private, offshore, and institutional balance sheet capital is accumulating on-chain. It's an ownership rotation. Public money out, long-term private money in.
Meanwhile, regulatory tightening is speeding up globally. We saw Italy issue a strong warning that crypto firms have to meet the EU's MiCA requirements by year-end or they have to shut down.
Yeah, that's the markets and crypto assets regulation finally coming into full effect. This is going to dramatically consolidate the market. Smaller, non-compliant firms will have to exit, which reduces those gray area venues and, most importantly, lowers counterparty risk for long-term investors.
It's painful in the short term, but it structurally validates the asset class.
It's a sign of maturity.
And we also got this really surprising macro angle out of Russia. A Kremlin aide characterized crypto mining as a hidden export that's actually skewing their ruble forecasts.
This is fascinating. It elevates mining policy way beyond just a discussion about energy grids. Mining essentially converts domestic energy, often stranded or wasted energy, into a global digital asset, Bitcoin.
And if that Bitcoin is then sold for dollars or euros?
It functions just like an export, generating foreign currency. But since it's decentralized, it's not always tracked in official trade stats, which can mess with macro forecasts. It shows that countries are starting to see mining as a serious economic lever.
And to wrap up the structural validation, let's talk about the legal sphere. Bitcoin is becoming, as the report puts it, an expert witness in courts.
This is a huge, under-the-radar development. The formal acceptance of the blockchain ledger as legal evidence is monumental. It lowers legal uncertainty, it proves traceability.
And we're seeing it in action.
We are. An international task force just dismantled an $815 million crypto fraud network using on-chain evidence. And there was an arrest related to the $243 million Genesis creditor theft. This increased law enforcement capacity really helps reduce that crime premium perception that's held the asset back.
So we've synthesized a huge amount of information here, from the price pivot at $93,000 all the way to global regulation. What is the core synthesis for an investor right now?
The synthesis is duality. The immediate trend is, well, it's mixed. It's volatile, it's sensitive, and it's carrying a historical cycle top warning. But the long-term structural viability of Bitcoin is being reinforced every single day through better infrastructure, legal acceptance, and regulatory cleanup. The foundation is getting firmer, even if the tactical risk is high.
Which brings the focus back to you, the listener. The key takeaway today isn't about trying to perfectly time that $93,000 break or guess tomorrow's ETF flow.
Not at all.
It's about focusing squarely on allocation discipline, sticking to that rules-based DCA framework, and on risk management. That means avoiding leverage when these historical caution signals are flashing.
Maintain your strategic size, but play defense. Volatility is designed to shake you out. A solid structure is what's meant to keep you in.
Well said. And here's the final provocative thought we want to leave you with. Even as public ETF capital showed that $195 million worth of caution, the simultaneous growth of regulated specialized banks and white glove services like Kraken VIP suggests the real competition for Bitcoin allocation is shifting. It's moving away from basic regulatory compliance and toward internal platform policies and advisor willingness. So the question is, what single internal policy change at just one major wealth management firm, say, lifting their internal cap on allocation, could unlock the next multi-billion-dollar wave of institutional demand? Something to think about as you maintain your discipline and watch those key price pivots.